Whilst the tension remains solidly on the unfolding events in Ukraine, the tension does shift a little bit this week towards the Fed, the Bank of England, and the Bank of Japan policy meetings coming up. We did see the European Central Bank kick it off last week with their March meeting. And let's say it's not an easy time to be a central bank making policy decisions at the moment. We have rising and persistent inflation. We have soaring energy prices and also stagnant growth, which is leaving us with this key term that everyone's now scared about, stagflation, and what this means for the economy. Do central banks now focus on tapering or controlling inflation regardless of what happens to growth, or are they there for the jobs market and fomenting growth, kind of losing a little bit their credibility on controlling inflation? Now, the ECB's messaging last week kind of reflects these issues and the uncertainty around what's the best policy action at the moment, especially as we have the situation unfolding in Eastern Europe, and we don't know what that's going to mean for trade and for energy prices in the near future. And pretty much what we saw from the ECB is we did see a bit of a hawkish message there coming from their tapering message, potentially ramping up that end of the stimulus in the economy, but also a whatever it takes message from Christine Lagarde to support the economy and to monitor inflation before any rate hikes are decided. So a bit of a two-spectrum end here, trying to calm the markets that, yes, there's going to be support, but inflation is also being looked at. And that's pretty much what we're expecting also from the central banks coming this week. It's pretty much a done deal that we are going to see the Fed and the Bank of England hike by 25 basis points this meeting. It's just the case of what's going to be the messaging around these meetings and what is going to be the projection for the near-term future and how they factor in potentially these issues in Eastern Europe and how this can affect or derail or alter their monetary policy in the coming months. Let's take a look now at the chart of the euro dollar to see how it's been performing since that meeting. And as you can see, this is the daily chart, and we did see a bit of a bounce higher here in the euro. As you can see, this was even prior to the meeting. We had that good momentum coming into the markets, with Europe talking about those bond issues to help soaring energy prices. That did breathe a little bit of air into the euro. That has now completely reversed, as you can see. And if we zoom out a little bit in the chart, you can actually see that we've now pretty much arrived to that 100% Fibonacci level. And what this means is that we've pretty much undone that rally that we saw from those lows in May 2020 to the high that we saw in January 2021. So pretty much undone as of now. We're now just waiting to touch that 100% Fibonacci retracement level. I wouldn't be surprised if that does come. Now, as I said, a lot of attention is going to be on the Fed and what this means. The dollar has been outperforming, but it has more to do with that liquidity factor in the market and what's been happening in the world rather than the data, because we have seen some economic data points coming out for the US and for other regions, and it doesn't seem to have a great effect in the market, not surprisingly, as they are potentially looking out for what liquidity has to do and what policy accommodation has to do. And that's been, the demand for liquidity has been the primary strength behind the greenback in the short term. So if we are looking at those interest rate hike odds in the market, we do see pretty much a 95% chance priced in that the Fed will hike 25 basis points this coming Wednesday at their March meeting. There is still a 5% chance priced into the market that we may see a 50 basis point hike. Now, if you are analyzing what may come out of this meeting, potentially before the conflict in Ukraine escalated, you could potentially support a higher interest rate hike from the Fed, especially as they were ramping up that messaging in the previous meetings that it was time to start hiking those interest rates in the short term. But now that we have this conflict unfolding, and it's still unfolding, there's still a lot of uncertainty, it does seem slightly likely that they would take such a step forward. They'd rather take a bit of a wait and see approach to see what may happen in the market. And especially now with the dollar strength, it does potentially look like we're going to be 100% sure that 25 basis point hike. Not so sure about a 50. It's also going to be very interesting to see what the summary of economic projections, what the dot plot has to say, and also the reduction in the Fed's balance sheet, how this impacts the dollar pair. So we also have the Bank of England on Thursday as well. As I was saying, 100% chance that we'll see a 25 basis point hike from the Bank of England. Now, they have already hiked in the past, and they were one of the first to do so, citing inflation and rising concerns about inflationary pressures as the main reason for them to hike early back in December. it's expected that we may see the same messaging at this meeting. The fact that we need to control inflation and how this is eroding purchasing power in the economy and consumers. But it's also going to be interesting what they have to say about growth, and especially those fears now with the conflict in Eastern Europe, how this can affect trade, how this can affect growth in the short term. So again, I think they're pretty much going to stick to a steady 25 basis point hike from the Bank of England, monitor the situation, a bit of a wait and see stance. I mean, the hike is 100% priced in now, so it's not going to be necessarily a very hawkish message from the Bank of England if they hike. It would be a lot more dovish if they didn't. The messaging around that would definitely be a lot more impactful for the pound. So all in all, we are looking for that stability from the Bank of England despite having that rate hike, because it's now fully priced in. Let's take a look now at a chart of the pound against the dollar to see how that is trading in the days prior to this meeting coming up on Thursday. As you can see, a bit of weakness here in the pound, just trying to break below that 130 line, as you can see, not having quite managed it at the moment. We are now just hovering above it. And again, if we are looking at those Fibonacci levels, we have now broken below that 38.2%. I was talking about this last week, the fact that the retracement in the pound had been a lot less severe than the euro against the dollar. It was pretty much a case of the Bank of England being a lot more hawkish, their messaging giving a lot more hope for pound traders. Now, the fact that we haven't retraced that much from those highs that we saw back in February and back in June 2021 does mean that we do have a bit more wiggle room for this retracement to deepen. I was talking last week about how I was expecting it to go down to that 50% Fibonacci retracement, 128.28. That's currently where it's sitting at the moment. I still see that quite likely. Again, we have the Fed meeting before the Bank of England. If we do see some more trading, some more momentum going into the US dollar on the back of these liquidity concerns, then we could potentially see the pair dip a little bit lower. Again, if you are looking at the Bank of England side of it and you are expecting to be a bit more hawkish, potentially the markets are expecting disregarding the conflict in Eastern Europe, staying on track with their policy commitment and all in all, giving that hawkish message, that message of, yes, we're here to combat inflation, we're here to help consumers and the economy grow, then potentially we could start to see a little bit more of a bullish momentum into the pound. That it is at a good place at the moment to do that. If we do see that bullish surprise from the Bank of England, we are at a good momentum right now. Those lows that we haven't seen since back here in November 2020 to actually stage a strong recovery, and we could potentially be heading back to that 23.6 Fibonacci at 135.76. So again, we'll need to monitor what comes out of the Fed first, but definitely the pound an interesting one to trade between Wednesday and Thursday, depending on how the pair moves after the Fed and just ahead of the Bank of England. And finishing off the central bank week on Friday, we will have the Bank of Japan. Again, a lot of expectations that the Bank of Japan will continue to be very dovish. It has been throughout the pandemic, not really changed much in their stance of supporting the economy. Inflation really lagging behind in Japan as it has in the past, really struggling to get even to that 2% mark that a lot of central banks seem as ideal. So again, definitely going to be the most dovish central bank, so it should at least in theory be so. Again, with these rapid rise in energy prices, we have potentially seen a little bit of indecision in Japanese traders of what this means, because the Japanese yen has always been considered a funding currency in a carry trade. It's now potentially moved more as a safe haven currency with all this conflict in Eastern Europe. And what does this mean for the Japanese yen? A weakening yen isn't good for those imports, especially a big importer of oil and energy, therefore hindering or hurting the local economy. So we could potentially see the Bank of Japan start to comment around this, potentially setting the way for a change in policy in the near future. I highly doubt it will happen now. There's a lot of uncertainty for them to do that. They'll probably want to wait and see and monitor, but we could potentially start to see those comments around that, setting up the tone for a change in the near future. Let's quickly have a look at a chart of the dollar yen to see again how that's been performing. I've been talking about this for a while, dollar yen being that carry differential, that rate differential trade of excellence, and it was really performing that way at the end of 2021, especially that fourth quarter as we saw that Fed messaging start to change while the Bank of Japan was really staying put. We've seen a strong push higher in the last few trading sessions, as you can see, now heading towards those 2016 highs, as you can see, right around 118.66. It's a question now, are we going to touch that again? I think yes, there's a really good chance that we may start to trend higher in this coming week, especially as we gear up to that Fed meeting. We've got some strong momentum going in today, especially that strong momentum on Friday's session, finishing roughly about just under 1% higher on the day, really breaking above 116 that had been a barrier in the short term. Also, this area here, 116.32, we had seen some resistance in the past in the last few months. Really, really strongly broke above that. So all in all, it seems like the path of least resistance for the dollar against the yen just seemed to be higher. And if we are comparing central banks, then we are expecting the Fed to be a lot more hawkish than the Bank of Japan.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.